Options in the stock market can either make you more money than you ever dreamed possible, lose you more money than you ever dreamed in your worst nightmare, or save you more money than you ever dreamed, guys. Today I'm going to explain to you all the basics around what options are if you are a stock market beginner. I cannot wait to share this with you guys today. Good day, subscribers. Thank you so much for joining me today. I am Jeremy. This is the Financial Education Channel, and today we're talking about options for beginners, guys. Stock market options for beginners. I'm going to go through all the basics with you guys today because this video has been requested by you guys over and over and over again in the comments section. You guys have wanted this video so bad. You know I'm an options investor. I buy and sell options. So today, I'm breaking it down for you beginners out there who maybe don't know what options are, or maybe you're looking into it a bit and you still don't really understand. I'm breaking down only the beginner stuff, guys. We're only getting into I guess you could say the things you need to absolutely know as a beginner in stock market options, guys. So we're not going to go into the super high level stuff. I'll probably do a video on that at some point in time, the super high level option type stuff. So let's just go ahead and get right into this, guys. We're going to go through 10 different things I'm going to explain to you guys. And then at the end, we're actually going to go through real examples on Apple stock and look at some Apple options and kind of show you my thought process about, call options and put options and those kinds of things, guys. So I hope you enjoy this. Hit a thumbs up if you do. Let's get into it, guys. So number one thing you got to understand is options are very complex, guys. And if you don't fully understand options at the end of this video, it's okay. It's okay. I always say you're in the minority if you do fully understand options at the end of this video and you don't already know what options are, guys. Options are very confusing, and so don't get frustrated with it, guys. Don't just say, I don't understand it because I didn't watch this video, so it's the end of things, guys. You take some time. Like, it took me like months to fully understand options, guys. I watched videos on it online. I read books about it. I Googled a ton of things, guys. I called my brokerage and talked to them for hours on the phone, and they tried to explain some things to me, guys. I talked to my investing partner about it, guys. There's so much stuff, and I'm a person who's actually decently intelligent when it comes to understanding money type matters, especially understanding anything in the stock market, guys. And it took me a long time to really understand options. And then once I did, I began to dabble in them and those kinds of things, guys. But it's not an easy subject. So I think that's very important to point out to you guys so you don't get too frustrated if you don't understand at the end of this video, or you even look into it past this video and you still don't understand. It takes time, guys. It's not an easy subject. I just want to tell you guys that so you know and you don't get frustrated, okay? So, number two, options are why do people even buy options? Why do people even play around with options? Options are really for three things. They're because you're betting that there's going to be big downside on a stock, you're betting that there's going to be big upside on a stock, or you need to hedge a position, guys. Those are the three main reasons why people even do options, guys. Either you're planning on the stock's going to go up a lot over time, so I need to buy options on that. The stock's going to go down a ton, so I need to buy put options, or I need to hedge a position, guys. And the hedging part of positions is the one that we're not going to get too into today because that's the most confusing part about how to play things with hedging. So that's the part we will not really get into, guys, because I don't want to overload your brains because we got a lot of stuff to talk about with these options, guys. So, number three. In order to do options, you have to have a brokerage account set up. So you have to have an account either through Fidelity or TD Ameritrade or Scottrade or E-Trade or one of those places, guys. You can get it pretty much through any of them. There might even be some other I think Options House might be another website. I haven't looked into that one. So all those type of websites, you have to have a brokerage account if you want to trade options, same as if you want to trade stocks. Also, number four, you need to sign an agreement. Almost every brokerage I know, at least, they make you sign an agreement. Basically, what the agreement wants to know is, at least the ones I've come across, they want to know how long you've been investing. They want to know your fundamental understanding on this subject or that subject. They want to know how much money you have. And if you don't meet certain criteria, guys, then you might not actually be able to do full-on options, guys. They might let you write calls and puts or something like that, but you might not actually be able to do full-on options, guys. There's an agreement you have to go through. It's not just like you sign up for it, guys. So understand that it's a little more complex than just signing a thing and sending away. They're actually asking you real questions, and either you're going to get approved or you're going to get denied at the end of that, guys. So understand that not just anybody can do options. Number 5. Now, this is the options definition, guys. I'm going to read this twice to you, okay? I'm going to read it twice in a row so you guys can understand it. Options definition. An option is a contract that gives the buyer the right, but not the obligation, to buy or sell an underlying asset at a specific price on or before a specific date. Let's read that back one more time. An option contract is a contract that gives the buyer the right, but not an obligation to buy or sell an underlying asset at a specific price on or before a certain date, guys. And if you still are kind of lost after that definition, I think when I show you the examples here in a couple minutes, you'll actually get to really see how all this breaks down and those kinds of things, guys. So if you're still confused after that definition, we'll get into it in the example, guys. And I think that, for me at least, if seeing examples of it done and hearing it that way, it's a little better than just hearing a definition. But hopefully that helps you guys. Number 6 here, guys. Options, the options that are purchased can be resold to someone else. So when you purchase, let's say you buy options, whether it's call options, put options, you buy those from somebody else. You can resell those before that date. So although there's going to be a certain date that those options expire, you can resell those to anybody else at any time. As long as there's a willing buyer out there at a certain price, guys, you can resell those. So when you buy options or sell options or whatnot, you're not locked in. Well, if you sell options as far as you're the one that actually writes the options, you're locked into that date. But if you're buying call options or you're buying put options for somebody, you can resell those at any time, guys. You can resell them a couple hours later, the next day, the next week, the next month, anytime before basically that date comes. And when that date comes, then you're stuck with them at that point, guys. Number 7, a call option is a bullish bet that a company is going to be at a certain price by a certain date. If you guys watched my 3 stocks I'm buying video, I actually told you guys that I bought like $4,000 worth of GoPro call options, basically betting that there's going to be a lot of upside before 2019 and playing it that way. So that's what a call option is, guys. On the reverse side, a put option is a bearish bet. So if you buy a put option, you're basically betting that a stock is going to go down, that stock's going to suffer, over that course of time, however long that option's for, guys. And by the way, the options, the longest out you can usually buy them is about 2 years. Sometimes you can get them about 2 years and 3 months out, but generally speaking, the longest out you can buy them is about 2 years, guys. So, there's tons of options that trade that are much more short-term in nature, like expiring next week or next month or the week after or something like that, guys. So call option, you're betting that the stocks can go up drastically or even at all. Put option is you're betting the stock's going to go down at least a little bit, if not a ton, guys. Keep that in mind. Number 9, the strike price is the price at which a call option can be exercised or a put option can be exercised. When the date comes, when that option expires, let's say that it expires January 1st, 2018. When January 1st, 2018 comes, you can only exercise that option if it's above the strike price if you bought the call option or below the strike price if you bought the put option, guys. That's what a strike price is. And once again, we're going to go through the example here in just a minute, and I think that will show you guys a lot better what we're seeing here. And the last one, number 10, the premium is the money paid by the buyer of the options contract. The person who receives the money is the seller, the one that's selling that options contract, or the original writer of the contract if they're the first ones to ever create that option, guys. So keep that in mind. Now, let's go ahead and actually get into some examples, and I think this is a better way of learning than just, the definitions, although you need to hear what these terms are and things like that, guys. So let's go over this. So right now we're looking at Apple. We're looking at Apple on the screen here, guys. These are options that are expiring March 21st, 2017. This video is going to be going up on March 8th or something, so it's only a few weeks away when these options will actually expire. So we're gonna kind of go through things here. So all the way in your left-hand side there, guys, in the blue box, you see that's a strike price of $115. A strike price of $115. We're looking at the top line here, guys. Now, the way the contract works as far as a contract name, and this is not really important, I just want to explain to you guys so you can understand the option, how an option contract name comes about. AAPL, that is Apple's ticker symbol. The 17 that follows that means it expires 2017. 03 is March. 24 is March 24th. So right there, you know it's an Apple contract that's expiring 2017, March of 24th. March 24th, 2017, that's when the Apple contract's expiring. Then it's usually followed up by 2 zeros and 115, you see that, 115, and then a bunch more zeros. That means it's a $115 strike price, guys. Now, the next row over, we see it says last price. That means the last price somebody bought that for is $20.20. So somebody paid $20.20 there for that call option. That's expiring here in a few weeks. So they're basically betting that the stock is going to be at least a minimum, because we had to add the premium plus the strike price. So $115 plus a $20 premium that they paid, well, $20.20 technically, is $135.20. So they're basically betting that the stock's going to be at least that, which right now it's actually above that, guys. So as long as the stock's above that, they're going to make money on the deal. If the stock keeps going up and it's on 140, then they're going to do pretty good on that trade. It's not a very risky bet when you're doing it in the money, which is what options trading is. And you might say, why the heck would somebody even sell that for that type of price, guys? Whoever sold it is on the other end is thinking that Apple stock is going to go under $135.20 by the time March 24th comes around, guys. So that's why somebody would sell that. Now, the next row over is the bid. That's what people are currently bidding for that options contract, $20.55. And the ask is what people are currently asking if they are trying to sell those option contracts. They're currently asking $20.85. So basically that options contract went up around $3 today, guys, in dollar amount, up about 17.7%. The volume, there's only 2 option contracts went through today, which, by the way, an option contract contains 100 underlying shares, basically. So it's basically 200 underlying shares in volume that went through. There's the open interest means how many option contracts are there out there that somebody's actually openly trying to get rid of right now. And there's 10 of them out there, guys. So that covers kind of what a call option is, and basically kind of just you kind of understanding these terms, guys. And I hope you can kind of understand that, and you may want to rewind if you need to hear any of those again. So now let's go ahead and we're looking at January 18th, 2019 options that are expiring here now, guys. These are something that I would actually buy. I'm not going to actually buy any of these in Apple, but I'm just saying when I do play options, I like to buy them out like 2 years in advance. So these ones aren't expiring for almost 2 years, you know, a year and 11 months or whatever. So there's something that would be of interest here. You know, I really believed a lot in Apple over the next couple of years. I could purchase $180 strikes there, guys. Let's look at the $180. So that's all the way in the left-hand column there. You see $180, and there's an Apple contract name. So last person bought those for $5.51. That's what they paid for them. Currently, the bid is around $5.30. The ask is about $5.80, as we see there. It went down a teeny bit today. There's a lot of volume in that. 429 contracts traded today, guys. There's 636 more people actually looking to sell theirs. So a huge amount of volume there, guys, for 2019 options. So basically, let's assume for a second that, and remember, this is a call option we're looking at here. Let's assume somebody pays, let's just make an even number, $5 for that $180 strike price, guys. Let's say the stock is at $180, or let's say it's at anything $180 or below. It come 2019, January 2019, when that contract expires. The one that bought that call option is going to lose 100% of their money, guys, because it's not even worth anything at that time. It's completely worthless. So they're going to lose 100% of their money if the stock is not at least $180 come 2019. Now, let's say the stock is at $185. They break even at that point because it's a $180 strike price. They paid a $5 premium, let's assume. So it's $185. So if it's $185 at that time, they broke even. Let's say it's at $190, guys. Then they doubled their money. They doubled their money just because it went to $190, guys. Because they paid $5 for the options. but it made another $5, so they're worth $10 now. So they actually doubled up their money, guys. Let's say it's at $200. Now they tripled their money. Now they tripled their money, guys, because they made back their original 5, then they made another 5 on top of that, then they made another 5 on top of that, and then they made another 5 on top of that to get to $200 if the stock price was at $200. So you can kind of see the power of options, guys. I mean, if, let's say, Apple, for some reason, it just went bonkers over the next couple of years, and it was a $250, $300 stock. Person would make 10, 20 times on their money, guys. They would make out like bonkers, guys. So that's the power in options. Now, on the put side is basically the same deal as with call options here. So let's assume somebody wants to buy, let's go down to the $80 strike price, and these are expiring 2019. So somebody, let's say, is very bearish on Apple. They think this stock is going to go down well below $80 by 2019. So the last price somebody paid for that was $2.05 in premium. The bid currently is $1.81. The ask is $2.10, guys. And we can see there's been 5 option contracts that went through today. There's an open interest of 1,883. There's a lot of people wanting to sell those because a lot of people don't think Apple's going to be going down anytime soon, especially not to $80. That's a drastic fall there, guys. And so what we see here is a situation that, say you're a believer Apple's, they're screwed, their stock's going to go down a massive amount for whatever reason. That's your thought process. So let's say you paid $2 for those put options at a strike price of $80. If the stock's not at least if the stock's at $80 or higher, you lose 100% of your money once again. If the stock's higher than $80, you're losing 100% of your money. If the stock, let's say, is at $78, you break even because you paid a $2 premium. It's a strike price of $80. So you need it to go to $78 just to break even and get your original money back. Let's say it falls to $76. Then you double your money up there, guys, because you make your original $2 of premium back and you get another $2 on top of it. So you make a total of $4 there, guys. You doubled up your money. Let's say it falls to $60, guys. Then we're talking you made 5 times on your money. You made 5 times on your money, guys. So drastic things can happen if you're way out of the money on those, guys. And as I told you guys recently, I bought some 2019 options on GoPro because I believe a lot in the company over the next couple of years. You guys probably know that if you follow me. And I paid $2.12 for a strike price at $10. And it's expiring in 2019. So I need GoPro stock price to be at least $12.12 to break even by January 2019. If it's not at least that price, then I'm going to lose money. If it's not at least $10, then I lose 100% of my money I bet on those options. So, and obviously if GoPro's at a $30 or $40, I'm going to make out like a bandit. So it all depends on how you want to play it, guys. Now, the hedging things I'm not going to go into in this video because I just want to cover the basics. This is a beginner options video, guys, and I hope this helped you understand options, guys. I was a little scared going into this video just because it's such a complex subject and it's very confusing. I've never known anybody in my life who learned options overnight, like, oh yeah, what's options? I don't know anything about them, and then they know it like by heart in a day. I mean, it takes weeks of studying, if not months of studying in most cases, guys. So I hope I did a decent job of explaining to you guys what they are. Do a lot more research on your own. Watch this video again back sometime after you read some books. There's a good show on CNBC every Friday about, if you have cable, every Friday. Usually comes out about an hour to 2 hours after the market closes. It's called Options Action. And it's just focused around options, and they have a couple traders on there, trade options and whatnot, and they talk about, oh, I bought this and did this, and they kind of explain it and whatnot. I think that's a good show if you have cable and if you feel like watching that, guys. It's called Options Action on CNBC. So anyways, I hope this helped you guys out today. Complex subject. It's very vital to know as an investor. Let me know if you ever want me to do a high level up type advanced options video. I can do that for you guys at some point in time. Let me know how I did explain this to you guys. I would love to hear some feedback from you because I'm a little paranoid about this video. If it was easy to understand those kinds of things, guys. Usually I'm very good at breaking down things, but I'm a little paranoid on this one, all right? So anyways, thank you so much for watching, guys. I hope you enjoyed this. If you just came across this channel, you've not subscribed yet, you may want to. We talk personal finance in this channel. We talk entrepreneurship on the channel. We talk the stock market on the channel, the most of everything. Thank you for watching, guys, and have a great day.